December 5th, 2024, Bitcoin crosses $100,000 for the first time in history. 10 days later, it reaches $108,319, the highest price ever recorded. This wasn't just a psychological milestone. An asset living on blockchain for 16 years finally reached 10% of gold's market capitalization. And the journey was brutal. In 2022, Bitcoin crashed to $17,000, but then three catalysts exploded. First, January 2024, the Securities and Exchange Commission approved spot Bitcoin exchange-traded funds. BlackRock, Fidelity, Grayscale, Wall Street giants flooded into Bitcoin. Second, April 2024, the halving happened. Supply was cut in half. Third, Trump won in November and embraced Bitcoin. Gary Gensler, the crypto-hostile SEC chair, resigned. Pro-crypto Paul Atkins replaced him. Three catalysts, 1 year. Result, 150% gains. But the question, is 100,000 the peak or just the beginning? Historically, Bitcoin goes parabolic after breaking psychological barriers. After 20,000, it soared to 69,000. After 100,000, where does it go? Bitcoin's road to $100,000 took 16 years. In 2009, Satoshi Nakamoto mined the first block. Bitcoin was worthless. By 2011, it reached $1. 2013, $1,000 during the Cyprus banking crisis. 2017, $20,000 in the ICO bubble. Then came the crash, 83% down to $3,200. Most declared Bitcoin dead, but 2020 changed everything. COVID hit. Governments printed trillions. Inflation fears drove investors to scarce assets. Bitcoin's fixed supply of 21 million became attractive. Institutional players entered. Paul Tudor Jones, Stanley Druckenmiller, MicroStrategy. By December 2020, Bitcoin crossed 20,000 again. Then the meme stock era fueled risk appetite. April 2021, Bitcoin hit $69,000, driven by retail FOMO and Tesla buying $1.5 billion worth. But leverage was extreme. May crash, China mining ban, and rising rates crushed prices. 2022, Bitcoin fell to $17,000, a 75% drop. The Terra Luna collapse, Three Arrows Capital bankruptcy, and FTX fraud devastated sentiment. Bitcoin seemed finished, but survivors knew every crash plants seeds for the next bull market. January 10, 2024. The SEC approves 11 spot Bitcoin exchange-traded funds. This was the breakthrough institutions waited for. Previously, buying Bitcoin required custody solutions, security infrastructure, and regulatory uncertainty. ETFs changed that. Now, pension funds, endowments, and financial advisors could buy Bitcoin through traditional brokerage accounts. BlackRock led the charge. Its IBIT fund, iShares Bitcoin Trust, became the fastest-growing ETF ever. In 11 months, it accumulated $52.1 billion in assets under management. Fidelity's FBTC raised $19.1 billion. Even Grayscale, despite losing $24.8 billion from its GBTC conversion, remained a major holder. Combined, U.S. spot Bitcoin ETFs absorbed over 1 million Bitcoin, 5% of total supply. The impact was immediate. Bitcoin jumped from $46,000 in January to $73,000 by March, before the halving even occurred. This was unprecedented. In previous cycles, Bitcoin established new all-time highs only after halvings. The pre-halving peak suggested institutional demand was compressing the traditional cycle. Analysts debated if this meant earlier peaks or sustained strength. April 19, 2024. Block 840,000. The fourth Bitcoin halving occurred. Miner rewards dropped from 6.25 Bitcoin per block to 3.125. Daily issuance fell from 900 Bitcoin to 450. This cut Bitcoin's inflation rate to 0.85%, lower than gold's 2.3% for the first time in history. The halving is Bitcoin's most powerful mechanism. Every 4 years, supply growth is cut in half. This ensures Bitcoin remains scarce while demand increases. The results are consistent. 2012 halving. Bitcoin went from $12 to $1,150, 8,858% gain. 2016, from $650 to $19,700, 294% gain. 2020, from $8,600 to $69,000, 540% gain. The pattern is clear. 12 to 18 months post-halving, Bitcoin peaks. For the 2024 cycle, historical timing suggests October to November 2025. Analysts like CryptoBurb and Fidelity Digital Assets agree. The acceleration phase typically produces blow-off tops in the year following a halving. Larry Fink's transformation embodies the institutional shift. In 2017, BlackRock's CEO called Bitcoin an index of money laundering. He dismissed cryptocurrency as a speculative bubble with no fundamental value. Fast forward to July 2024. Fink appeared on CNBC and said, "My opinion 5 years ago was wrong. I'm a major believer that there's a role for Bitcoin in portfolios. It is digital gold." By January 2025, Fink was speculating Bitcoin could reach $500,000 to $700,000 if sovereign wealth funds and institutions allocate 2 to 5%. What changed his mind? Client demand. BlackRock's asset management clients, pension funds, insurance companies, family offices, asked for Bitcoin exposure. The firm responded with IBIT, which became its most successful ETF launch ever. Goldman Sachs invested $1.3 billion. The Wisconsin Investment Board, a public pension fund, invested $321 million. Norway's sovereign wealth fund holds $356 million in indirect Bitcoin exposure. Even conservative institutions couldn't ignore it. Bitcoin's correlation to traditional assets remained low, providing diversification benefits. And its performance, 150% gains in 2024, outpaced every major asset class. November 5, 2024. Trump wins the presidential election. Crypto markets exploded. Why? Trump campaigned as the crypto president. He promised to fire Gary Gensler, end the SEC's war on crypto, and establish a Bitcoin strategic reserve. Gensler resigned effective January 20, 2025. Trump replaced him with Paul Atkins, a former SEC commissioner known for market-friendly, innovation-focused approaches. But the real bombshell came March 6, 2025. Trump signed an executive order establishing the U.S. Strategic Bitcoin Reserve. The government capitalized it with approximately 200,000 Bitcoin, worth roughly $17 billion, from seizures. The order prohibited selling. Bitcoin became a strategic asset, like gold. This was historic. A world superpower officially recognized Bitcoin as a reserve currency. Senator Cynthia Lummis reintroduced legislation proposing the U.S. purchase 1 million Bitcoin over 5 years. Treasury and Commerce departments received authorization to develop budget-neutral acquisition strategies. Additionally, Trump disbanded the DOJ's National Cryptocurrency Enforcement Team. The SAB 121 repeal allowed banks to custody crypto, and a prohibition on central bank digital currencies protected Bitcoin's decentralization. The regulatory transformation was complete. Wall Street's Bitcoin forecasts for 2025 cluster around $150,000 to $200,000. Tom Lee of Fundstrat predicts $150,000 to $250,000, citing halving dynamics and institutional adoption. J.P. Morgan forecasts $165,000 to $170,000, based on a gold-adjusted volatility model. Their analysis suggests Bitcoin should consume 1.8 times more risk capital than gold, given its higher volatility, but similar safe haven properties. Bernstein Research published a $200,000 target in October 2024, calling it a new institutional era. Van Eck maintained $180,000 through August 2025, arguing there's no technical resistance above prior highs. But not everyone is bullish. Standard Chartered slashed its forecast from $200,000 to $100,000 in December 2025, noting corporate Bitcoin buying has run its course and ETF inflows have decelerated. Galaxy Digital cut its target from $185,000 to $120,000, citing market maturity and whale distribution. Cathie Wood's ARK Invest remains most aggressive. Base case of $700,000 by 2030 with a bull case of 2.4 million if institutional allocation reaches 6.5%. $150,000 requires Bitcoin's market capitalization to reach approximately $2.97 trillion, assuming 19.8 million Bitcoin in circulation. This represents a 50 to 65% increase from current levels of roughly $90,000 to $100,000. For context, this would be 10 to 17% of gold's total market capitalization of roughly 15 trillion. Is this feasible? Historical precedent says yes. In previous halving cycles, Bitcoin increased 300 to 540% from halving price to cycle peak. The 2024 halving occurred at $64,000. A 300% gain reaches $192,000. Even a conservative 200% gain reaches $128,000. The supply-demand imbalance supports this. ETFs absorb 500 to 1,000 Bitcoin daily. Miners produce only 450. The deficit must be filled by existing holders selling. But on-chain metrics show holders aren't selling. Exchange balances fell to 6-year lows of 2.6 million Bitcoin. The MVRV ratio, market value to realized value, sits at 1.7 to 2.1, far below the 7 to 9 readings that signal cycle tops. Whales accumulated during the dip to $85,000 in December 2024, suggesting institutional confidence remains strong. The stock-to-flow model, created by pseudonymous analyst Plan B, measures Bitcoin's scarcity by dividing existing supply by new production. Post-halving, Bitcoin's stock-to-flow ratio reached approximately 120, exceeding gold's 62. Plan B maintains a 2025 average price target of $500,000, with a range of $250,000 to $1 million. However, the model faces criticism. Ethereum co-founder Vitalik Buterin called it finance astrology, noting it ignores demand factors. The model predicted Bitcoin would average $288,000 in 2021. It peaked at $69,000 and averaged $57,000. Critics argue the model worked during Bitcoin's early monetization phase, but breaks down as Bitcoin matures. Still, cycle theory remains relevant. Historical patterns show peaks occur 518 to 580 days post-halving. For the 2024 cycle, this suggests October 19th to November 20th, 2025. Analyst CryptoBurb's technical analysis projects October 15th to November 15th. The convergence of models, timing patterns, and institutional forecasts creates a compelling case that late 2025 represents the probable peak window, though exact prices remain uncertain. The Federal Reserve poses the most significant threat to Bitcoin reaching $150,000. December 2024's FOMC meeting revealed a hawkish pivot. The Fed cut rates to 4.25 to 4.5%, but projected only 2 rate cuts for 2025, down from 4 projected in September. 7 officials indicated they want 0 cuts. Chair Jerome Powell signaled a pause phase, citing core PCE inflation at 2.5%, well above the 2% target. Bitcoin historically correlates negatively with dollar strength. When the DXY index rises, Bitcoin typically falls. The dollar strengthened from 100.9 in August 2024 to over 107 post-election. If the Fed maintains high rates and the dollar strengthens further, Bitcoin's upside is capped. Additionally, rate cuts were a key bull thesis. Lower rates reduce the opportunity cost of holding non-yielding assets like Bitcoin. If cuts are delayed or canceled, institutional appetite could weaken. However, some argue Bitcoin is transitioning from a risk-on asset correlated with tech stocks to a risk-off store of value like gold. If this thesis proves true, Fed policy matters less. The debate rages. Is Bitcoin digital gold immune to rates, or a tech speculative asset that requires liquidity? The bear case rests on several factors. First, ETF flow deceleration. Standard Chartered notes quarterly inflows dropped to 50,000 Bitcoin, the lowest since launch versus 450,000 in late 2024. This suggests early institutional enthusiasm is fading. Second, whale distribution. Galaxy Digital estimates 470,000 Bitcoin, approximately $50 billion, was distributed by whales in 2025. This selling pressure could cap upside. Third, Mt. Gox distributions. Approximately 79,600 Bitcoin remains to be distributed from the 2014 exchange collapse. If recipients sell, it adds supply. Fourth, elevated sentiment. The Fear and Greed Index hit 88, extreme greed, in late November before collapsing to 21, extreme fear, by late December. This volatility suggests the market is fragile. Fifth, the pre-halving all-time high anomaly. Bitcoin peaked before the halving for the first time ever. Some analysts argue this signals the cycle is compressed or even ending early. If true, the traditional post-halving rally may not materialize. The bear case sees Bitcoin correcting to $70,000 to $85,000, potentially retesting the 2024 consolidation range before attempting higher prices. Risk management demands acknowledging this scenario. December 2024. Bitcoin crossed $100,000, reaching $108,319. It was a 16-year journey from worthlessness to a $2 trillion asset. Three catalysts converged. ETF approval brought $52 billion from BlackRock alone. The April halving cut supply to 450 Bitcoin daily. Trump's election and strategic Bitcoin reserve transformed the regulatory environment. Larry Fink, once a Bitcoin skeptic, now predicts $500,000 to $700,000. Wall Street consensus clusters around $150,000 to $200,000 for 2025. Historical halving patterns suggest an October-November 2025 peak. The math works. ETFs absorb more Bitcoin than miners produce. Exchange balances are at 6-year lows. On-chain metrics show accumulation, not distribution. But risks remain. The Fed's hawkish pivot to only 2 rate cuts for 2025 threatens liquidity. ETF inflows have decelerated, whales distributed heavily, and Bitcoin's pre-halving peak broke historical patterns, raising questions about cycle timing. $150,000 is achievable, but not guaranteed. The structural bull case is intact: scarce supply, institutional demand, regulatory clarity. But execution depends on macro conditions. Is 100,000 the beginning or the peak? 2025 will answer.